So Chuck, another interesting quarter in the overall market. We saw a correction in August. We saw a rally. Now we're seeing another correction in the end of the month of September. What are your thoughts on the most recent correction?
The correction is really just that. It is a very normal process. Corrections are part of the market's fabric, always have been, always will be. We get a 10% plus correction almost every year throughout time. I don't see anything different in this correction than just that. So I would put it very much in the kind of normal range. Even if it expands to minus 15% or so, I would still think of it that way.
One of the more interesting things about this correction and the correction we had last year, we had a 12.8% correction in the market last year. It seems to be an economic growth scare. And we've seen several of these over the past several years, really, driven by our own fears of a double-dip recession in the United States, fear of Europe's problems or Greece, and now it's Asia, specifically China. Are you finding opportunities in the market because of that?
Sure, we get a fear of something in these that triggers these things, but I really put them in the context of markets are cyclical, volatility is very normal, and certainly it will be healthy to shake out some of the speculative excess, and that's what's going on. Of course it sets up plenty of opportunity.
One of the things we've been hearing about, especially following the Fed meeting, was almost a growth scare from a global standpoint. What are you hearing from companies today from a bottoms-up standpoint about their outlooks, their growth that they're seeing from their businesses?
I would say we see, in general, very positive responses. Of course, in the economy of our size, we have a variety of trends going on simultaneously. In the energy sector, of course, there's large weaknesses going on. But in other sectors, we're booming. You know, home building is booming. Some of the other sectors outside of energy or industrial areas are booming.
We talk a lot about real companies and their effect and how the real companies in the economy really haven't benefited from anything that the Federal Reserve has done over the past several years. And a tightening by the Federal Reserve at some point this year would actually be stimulative to the overall economy, could start a new business cycle where companies that actually have profits and earnings matter. Because one of the things we've seen this year is negative EBIT companies outperforming. Do you think that's going to change?
I absolutely do. I think we're already seeing that in this third quarter. Part of this correction is about a shift of what kind of company gets favored, and I see that shift being exactly what you're talking about, towards real companies. And I am thrilled with that shift. I do think the return to normal in this market sentiment is going to benefit the kinds of stocks we favor, the real companies, the higher quality companies.
How important is risk management in the small cap space at this particular crossroads in the market then?
Risk management is critical in the small cap space. Risk management has been underappreciated in this essentially straight up market. We've had a 6-year from the lows from the spring of '09 right through June. We had a 6-year almost 17, 18% compound return, way off the charts. Numbers are coming down now. We're having this correction. A new cycle will set up a new favoring of what you called real companies.